Hi, my name's Aaron Engelman from Two Teachers Tax Service here in Lyman, South Carolina. Today, I'd like to talk about capital gains and how they're taxed. Capital gains, there's two different kinds. There's realized and there's recognized. Realized gains are profit from selling an asset. The recognized gain is the portion of that realized gain that is taxable. You might say, well, it's all taxable. No, it's not. So we can talk about that as we go through this. Understanding the difference is the key for tax planning and tax compliance. Realized gains are profit from a completed transaction. And the formula is the amount realized, that's the amount of money that you take in when you sell it, minus the adjusted basis, which is the original cost of the asset. When you sell, it triggers a realization event. So the example is you buy a painting for $1,000, you sell it for $5,000, your realized gain is $4,000. Recognized gains are the taxable portion of a realized gain. The formula is the recognized gain is equal to the realized gain minus any amounts that you can exclude from taxes or defer from taxes. So the example here is you buy a painting for $1,000. You sold it for $5,000. Your realized gain is $4,000. Now, if that full $4,000 is taxable, the recognized gain is $4,000. So here's a table that shows the difference between realized gains and recognized gains. The realized gain is the total profit. The recognized gain is the taxable portion of that profit. Your realized gain occurs when you sell an item. So you buy it for $1,000, you sell it for $5,000. At the time that you sell it for $5,000, you have realized a $4,000 gain. A recognized gain is when you report a realized gain on your return as taxable. The tax status of a realized gain may not be taxable immediately. Imagine you buy something in January, you sell it in February. You may not end up paying any taxes on it until the following April. Recognized gains are always taxable. The value of a realized gain may be higher than a recognized gain, and the value of a recognized gain compared to a realized gain may be lower. There are a couple of times that we encounter what are called non-recognition provisions. So the first one is the Section 1031 like-kind exchange. Sometimes people just call these 1031s or a 1031 exchange. And the way this works is it defers tax on qualifying real property exchanges. Okay, so you have an investment of some type, and you exchange that investment for another investment that is the same or substantially similar. You don't have to pay tax on that right away. You defer that until you sell that second property. And you can have these go on for quite some time. So you could have a Section 1031 deferred gain, another Section 1031 exchange. They kind of daisy chain. The other one, and this happens all the time for people, the principal residence exclusion. And you can exclude up to $250,000. That's for a single person, or $500,000 if requirements are met. Here's what you need to know. All recognized gains are realized, but all realized gains are not recognized. Realization is an economic event. You got that money and you have profited. Recognition is a tax event. I have seen how much I've profited and now I've got to pay the tax guy. Strategic use of exclusions and deferrals can reduce your tax burden. Of course, if you have questions, contact us at Two Teachers Tax Service. And our contact is 269-449-8277 or by email at twoteacherstax@gmail.com. Thank you.